Gold just hit $6,000 an ounce. I need you to really hear that number. 6,000. Not on COMEX, not in London. Those markets were closed. Gold hit $6,000 in Chinese weekend dark market trading while every major traditional exchange on earth was shut down. That is $750 above Friday's close. In a single weekend, in the middle of a war, and that's not even the most alarming part. A Chinese bank, Shang Bank, issued an official notice to customers dated February 28, 2026. In it, the bank warned that because of extreme price volatility and drying market liquidity, it may temporarily suspend its gold savings business. Buying gold, selling gold, physical gold exchanges, all potentially halted. A bank in the world's second largest economy is openly telling customers it may stop gold trading because supply inside its system is running thin. That is not a routine correction. That is strain inside the financial plumbing itself. Vault inventories are being drawn down. Liquidity is evaporating. And when liquidity disappears, systems crack. And by the end of this video, I'm going to explain why this may only be the first domino, how it could spread to other institutions, and why silver is sitting on even more unstable ground than gold right now. But first, we need to break down what happened in the last 24 hours, because the chain of events that pushed gold to $6,000 is so extreme that most people haven't processed the implications yet. Every one of these events carries consequences for global markets. The supreme leader of Iran, Ali Khamenei, has reportedly been killed in a precision strike attributed to the United States and Israel. According to statements circulating from former U.S. President Donald Trump, the strike eliminated one of the most powerful political figures in the Middle East, a man who led Iran for over 3 decades. Satellite images show the compound reduced to rubble. This was not a strike on a weapons depot, it was the targeting of a sitting head of state, and that changes the geopolitical equation dramatically. Because once leadership is targeted directly, the conflict no longer follows a predictable military cycle. It becomes existential. Here's how the escalation unfolded. Phase 1. Coordinated U.S. and Israeli strikes on Iranian military and defense infrastructure, missile facilities, command sites, strategic assets across Tehran and other cities. Iran's defense minister reportedly killed in the initial wave. Israel declared a full emergency posture. U.S. embassies across the Gulf locked down. Gold was already trading near 5,194s at that stage. Phase 2. Retaliation. Iran launched missiles not only toward Israel, but across the region. Dubai, Qatar, Bahrain, Kuwait, Riyadh, Abu Dhabi. A U.S. naval installation in Bahrain was struck directly. Several missiles reportedly penetrated layered air defense systems. That detail matters. The United States spends over $800 billion annually on defense. Systems like Patriot, THAAD, and Aegis are designed to create defensive shields over strategic assets. If incoming missiles are getting through, it suggests either overwhelming saturation or advanced speed and maneuverability. Neither explanation is comforting. Iranian officials stated publicly that only their weakest missiles had been used so far. Whether that's strategic messaging or reality, intelligence discussions around hypersonic missile transfers from Russia and China have intensified. Defense analysts in Beijing have openly speculated about the vulnerability of large naval assets in high-intensity conflict scenarios. A former CIA officer recently stated that there is currently no guaranteed defense against hypersonic weapons traveling at those velocities, and that a successful strike on a U.S. carrier group could trigger global escalation. That is the level of conversation happening right now in intelligence circles, and markets are listening. Phase 3. Leadership targeting. The reported strike on Khamenei was followed by public rhetoric encouraging political upheaval inside Iran. Calls for regime change fundamentally alter the duration and scale of any conflict. Because conventional wars have off-ramps, regime change wars rarely do. And that distinction is critical for precious metals. Gold rises in uncertainty, but it accelerates when the financial system begins to question stability itself, when a major bank warns of halting gold transactions, when liquidity disappears during closed market hours, when geopolitical escalation moves from tactical strikes to leadership removal. Markets start pricing in systemic risk, not just volatility. And here is where silver enters the picture. Gold is a monetary metal. Silver is both monetary and industrial. In extreme stress environments, silver inventories can tighten faster because industrial supply chains are already thin. If capital begins flowing aggressively into physical metals while supply chains are disrupted by conflict, silver's squeeze potential becomes amplified. What we're seeing may not be a spike. It may be repricing. The difference is massive, because spikes retrace. Repricings establish new floors. Right now, dark market trading is signaling something traditional exchanges haven't reopened to reflect yet. The real question is not whether volatility continues. The question is whether this weekend marked the beginning of a structural shift in how metals are valued in a world that suddenly feels far less stable. And if liquidity continues drying up, $6,000 may not be the number people remember. It may be the starting point. In a normal conflict, both sides exchange strikes, declare victory, negotiate a ceasefire, and markets calm down. That's what happened the last time Israel and Iran clashed. Limited damage, symbolic retaliation, quiet diplomacy, gold spiked, and then settled. That playbook is gone. When a nation's supreme leader is killed, the off-ramp disappears. If Ali Khamenei is truly gone, there is no single authority figure left in Iran with the unquestioned power to negotiate a ceasefire, even if they wanted one. The defense minister was reportedly killed earlier. Now the top of the command structure has been removed, and the people still standing, they are not diplomats. They are military commanders, Revolutionary Guard generals, hardliners. They escalate. Behind them are 88 million citizens who just watched their leader reportedly die in a foreign missile strike. Iranian media has been flooded with images of destruction. Anchors visibly emotional. The atmosphere inside the country is not political. It's emotional. And emotion combined with ballistic missiles is one of the most dangerous combinations in geopolitics. Iran's ambassador to the United Nations reportedly delivered a cold warning to the U.S. delegation that politeness would be better for them. That is not surrender language. That is deterrence language. Former Israeli defense officials have publicly warned that the consequences of these actions could last decades. When the planners themselves talk about generational fallout, you pay attention, and escalation is already visible. Dubai, one of the most globally connected cities in the world, has reportedly faced missile threats. Airports across the UAE have experienced shutdowns, flights cancelled, travelers stranded. Saudi Arabia has condemned Iran and signaled it may intervene directly. If Saudi Arabia enters, this becomes a regional conflict, not a bilateral one. And this is the moment where war stops being a headline and starts affecting your bank account. Because everything described, assassination, retaliation, regional escalation, is being priced into gold and silver in real time. You already know gold touched $6,000 in Chinese dark market trading. You already know a Chinese bank warned about suspending gold transactions due to inventory strain. But here's what people are misunderstanding. $6,000 is not a prediction. It is not a target. It is a transaction price, paid by real buyers with real money while traditional exchanges were closed. That is what gold was worth when traders could see missiles flying in real time. The $5,150 paper price from Friday, that price belonged to a different world, a world where regional leadership was intact and major cities were not under threat. That world changed. When COMEX in London reopen, paper markets will have to reconcile with what physical buyers already expressed. And when that catch-up happens, the pressure could be extraordinary. The notice from Shang Bank is critical. When a commercial bank warns customers it may suspend gold trading due to inventory depletion, that is not speculation. That is plumbing stress inside the physical system. And this is not a hedge fund trade. This is not futures leverage. This is a bank telling customers, we may not have the metal. When exchanges reopen and institutions rush simultaneously into safe haven assets, banks already low on inventory face a decision: sell gold they don't physically hold or close the window. One bank is already signaling it may close. Others could follow. Now let's talk about silver, because this is where the pressure becomes even more extreme. Silver's total market is a fraction of gold's size. The entire above-ground silver market is smaller than the quarterly revenue of Apple Inc. That's how small it is. Into that tiny market, you now have converging demand. Safe haven buying, industrial consumption, military manufacturing, strategic stockpiling. Industrial demand doesn't slow during war. It accelerates. Missile systems, interceptors, guidance electronics, communications equipment, satellites, all rely on silver in wiring, soldering, and high conductivity components. And that's before we even mention the solar sector, already consuming record volumes. You now have two of the most silver-intensive forces on Earth, the green energy transition and active military operations, competing for constrained supply at the same time. Silver was already in structural deficit before any missiles launched. Now demand has spiked into that deficit. Mexico, the world's largest silver producer, continues facing mining disruptions. China has tightened export classifications around strategic materials. COMEX vault levels have reportedly been declining. Supply hasn't just tightened, it has thinned. Now connect this to the Strait of Hormuz. Roughly 20% of global oil flows through that narrow passage daily. Iran sits directly adjacent to it. They don't even need a full blockade to disrupt markets. Missile capability alone changes risk pricing. Insurance rates for tankers surge. Shipping costs spike. Energy markets react instantly. Even if oil continues flowing, the cost of moving it increases dramatically. That cost flows downstream. Refiners, gas stations, consumers. Oil at $150, $200 per barrel stops being a worst-case scenario and becomes a baseline projection if escalation persists. And now consider the Federal Reserve. Before any of this, the Fed was already cornered. Inflation elevated, producer prices hot, growth fragile. They couldn't cut aggressively without risking renewed inflation. They couldn't tighten aggressively without risking recession. That was the dilemma in peacetime. Add war-driven energy inflation and supply shocks into the mix, and monetary policy becomes almost irrelevant. Because once geopolitics overrides economics, central banks react. They don't lead. And gold and silver move first. What we are watching right now may not be volatility. It may be repricing under geopolitical stress. And repricing is not a spike. It's a reset. Now add an oil shock from the most critical shipping lane on Earth. A war expanding by the hour. Diesel prices doubling. Food prices spiking because transportation costs explode. At that point, the Federal Reserve has no moves left. None. They become spectators, because when inflation is being driven by war, shipping disruptions, and energy spikes, interest rates don't fix that. Monetary policy cannot reopen a shipping lane, it cannot intercept missiles, it cannot rebuild destroyed infrastructure. And in a world where central banks are powerless, capital moves toward the only money with no counterparty risk: physical gold, physical silver, metal you can actually hold. Russia has issued a warning that should not be ignored. Officials stated that U.S. and Israeli strikes on Iran could risk triggering a radiological catastrophe. Think about what that implies. Either strikes landed near sensitive nuclear infrastructure, or there is concern about escalation involving nuclear capability. Some analysts have even raised the possibility that Iran could conduct an underground nuclear test to demonstrate capability. Now understand why that possibility matters so much for gold. If a nuclear device is detonated, even underground, even as a test, the geopolitical equation changes overnight. Iran would no longer be viewed simply as a nation under attack. It would be seen as a nuclear-armed state whose leadership was just eliminated. Everything recalibrates instantly. Saudi Arabia would not sit idle. Turkey would reassess its posture. Every nation within missile range would begin strategic calculations they've never had to make before. In that scenario, the rush into precious metals doesn't just increase, it becomes historic. Gold at $6,000 would not be a ceiling, it would look like a floor. And here's the key point: whether Iran actually conducts such a test is almost secondary. What matters is that intelligence officials and former operatives are publicly discussing the possibility. When the word nuclear enters mainstream geopolitical analysis, markets pay attention, and they are paying attention right now. There is another trigger being closely watched: U.S. aircraft carriers in the Persian Gulf. If a carrier were struck, the political pressure inside the United States would escalate immediately. Congressional restraint would likely vanish. The response would not be symbolic, it would not be calibrated, it would be overwhelming. At that stage, escalation risks multiply dramatically, and every central bank, sovereign fund, pension manager, and institutional investor would reach simultaneously for the one asset that historically survives systemic war: gold. Demand in that type of environment cannot be modeled using normal financial assumptions. Now let's be direct. A nuclear test, a carrier strike, Saudi Arabia entering the conflict, or a prolonged regional war dragging on for years. Any one of those, just one, would send gold and silver into price territory the modern market has never processed before. And looking at the speed of the past 5 days, it is difficult to dismiss those possibilities outright. Let's zoom out and review the sequence clearly. 5 days ago, silver was trading near $94. Iran nuclear negotiations had collapsed. 3 days ago, coordinated strikes began. Gold spiked toward $5,294 in tokenized trading. Silver touched $120 in parts of China. Dealers reportedly paused sales. Then retaliation. Missiles struck regional targets. Air defenses were tested. Regional tensions surged. Then reports emerged of leadership elimination. Diplomatic language hardened. Gold traded at $6,000 in Chinese dark market hours. A Chinese bank warned of potential inventory strain. In less than a week, markets moved from fragile tension to systemic risk. That is the velocity we are dealing with. Now consider what happens when major exchanges reopen. Gold closed near $5,250 on COMEX. Dark market trading indicated $6,000. That is a $750 gap. When markets reopen, traders globally will attempt to reposition simultaneously. Liquidity may thin. Market makers may widen spreads. Volatility could spike sharply. If short positions are deeply underwater, margin pressure can force buying, and forced buying accelerates price moves. For silver, volatility could be amplified. Silver's market is significantly smaller than gold's. It requires far less capital to move it aggressively. In crisis environments, the gold-to-silver ratio historically compresses as silver catches up rapidly. If gold sustains higher levels and the ratio tightens sharply, silver prices could move dramatically in percentage terms. For example, at a 30.1 ratio with $6,000 gold, silver would mathematically sit near $200. That is not a prediction. It is arithmetic. The larger point is this. We are no longer talking about gradual monetary shifts. We are talking about geopolitical repricing, oil risk, supply chain risk, military escalation risk, nuclear rhetoric risk. When multiple systemic risks converge at once, markets do not adjust smoothly. They gap. And when they gap, the assets without counterparty risk are the ones that absorb the shock first. Whether this escalates further or stabilizes unexpectedly, the next market open will likely be remembered for its volatility, because the math and the geopolitics demand it. That's the math. And this is what I told you at the beginning. Silver is in worse shape than gold. Here's why. Gold's stress right now is primarily demand-driven. Too many buyers chasing limited supply. In theory, that imbalance can normalize if supply responds. Silver is different. Silver has exploding demand, just like gold. But at the same time, supply is tightening structurally. Mexico, the world's largest producer, has faced disruptions. China has restricted exports of strategic materials. Inventories on COMEX have reportedly been trending lower. Dealers in Shenzhen have paused sales at elevated prices. And now layer wartime industrial consumption on top of that. Gold has a demand surge. Silver has a demand surge, a supply constraint, and increased industrial and military consumption, all at once. When a bank like Zhashang warns about gold inventory strain, that's serious. But if the silver market experiences true physical shortages, there is no global silver OPEC that can suddenly increase output. Silver supply comes from mines, projects that take years, sometimes a decade, to develop. Structural deficits cannot be fixed in weeks. They cannot be fixed in months. They are resolved by price. And during periods of geopolitical escalation, price adjustments can be extreme. Let me be direct. I have followed gold and silver markets through rallies, crashes, fear trades, and short squeezes. This feels different. Every previous crisis had a boundary. A pandemic eventually stabilizes. A trade dispute eventually negotiates. An election eventually concludes. But a reported assassination of a long-standing head of state, such as Ali Khamenei, if true, cannot be undone. A nation of 80+ million people does not simply reset emotionally overnight. Strategic waterways do not become risk-free because a statement is signed, and metal that is not in a vault does not appear because demand increases. There is no reset button for structural stress layered on top of geopolitical escalation, and markets without clear reset points tend to trend until equilibrium is forcibly restored. Now, to those who have held gold and silver through this entire move, you bought metals because you believed the system carried hidden fragility. You saw rising debt. You saw geopolitical tension. You saw supply chain vulnerabilities. This is the type of environment those preparations were meant for. Precious metals are doing what they historically do during uncertainty, attempting to preserve purchasing power while risk is repriced. There will be volatility. There will be rumors of ceasefires that knock gold down $200 in an hour. There will be social media calls of the top, and there may be sharp reversals if tensions cool temporarily. That is the nature of conflict-driven markets. But structurally, every supply warning, every energy disruption, every escalation headline reinforces the long-term thesis for hard assets. For those watching from the sidelines, I understand the hesitation. Gold at $5,000 felt expensive. Gold at $5,500 felt expensive. Now gold at $6,000 feels even more so. At some point, the internal question shifts from, is this too expensive? To, has the repricing already begun? I'm not here to tell you what to do with your money. I'm telling you what I observe. A physical market that appears to have repriced faster than the paper market. A widening gap between perception and transaction reality. And major exchanges reopening into a geopolitical backdrop that is materially different than it was days ago. That can create volatility. Significant volatility. Let me leave you with this perspective. In a single week, markets have had to process escalating regional conflict, energy route risk, inventory strain warnings, air defense vulnerabilities, hypersonic weapon discussions, nuclear rhetoric, open talk of regime change. There are few modern parallels for that cluster of risks converging simultaneously. This is no longer about technical indicators or moving averages. It's about a fundamental financial question. When uncertainty rises sharply, what assets carry the least counterparty risk? Government promises backed by debt, digital balances at institutions facing liquidity strain, or tangible assets that have historically functioned as stores of value for thousands of years? Right now, the market's answer appears to be clear. If you're new here, I've been tracking each stage of this situation as it developed. Review the progression, watch how the narrative evolved, and decide for yourself how the pieces fit together. When markets reopen, volatility will likely be intense. Does gold hold $6,000? Does silver compress the gold to silver ratio further? Do tensions escalate or unexpectedly cool? We are in uncharted territory. Stay informed, stay disciplined, and make decisions based on structure, not emotion. The world may not have fully changed yet, but the risk landscape clearly has.